The Genius Act has officially passed and is in the process of becoming law. However, a lot of people are complaining that giving private companies the right to issue currency leads to disaster. They will often refer to the free banking disaster or the Wildcat Banks in the antebellum USA, and they will tell you that, look, we have already seen in the past that free banking doesn't work. You cannot simply give the rights to print money by private companies or private banks. However, that is not the case. Not only was free banking not a disaster, it was actually widely successful in countries like Scotland and in Canada. And actually, before I go into this topic in details, I want to credit Nick Carter because he very recently he wrote one of his Substack pieces, "The Last Word: Stablecoins and Free Banking." And this is a huge inspiration for this episode. So if you haven't read it, it's a must read. I will link to the article in the description. But however, whatever he has covered, I want to go a bit deeper into it and actually look how these free banking regimes in the Scotland and in Canada actually worked, what the failures looked like, and how it actually was a much robust infrastructure than what you may expect. And more importantly, most people will simply refer to the antebellum USA banks, and it will say, look at those banks. They simply didn't work. Most of these banks were fraudulent, stuff like that. But the USA actually failed not because it was free banking. It was because the lack of freeness in the banking that actually led to the disaster. So super excited to cover this entire episode and see where this leads us, and can we actually believe that free banking is the net negative for the industry? Yeah, so let's start with the most common criticisms that we are facing right now, the industry as a whole is facing right now. Okay, so I've actually prepared this sort of slide.
So
that
looks cool.
Then let's take a look at the primary arguments against free banking or whatever like the stablecoin is going to do, which is pretty similar to what free banking looked like. So number one is private money. Private money leads to instability. So as they said, like in the US, free banking banknotes often failed to hold value because issuers collapsed, couldn't redeem notes, or were under collateralized, and they think that stablecoins are going to face a very similar fate, that one bad run could cause depegging and loss of trust in the sector. And all of these claims are extremely rebukable and refutable. So, but let me just cover all four of them at first, and then I will just go one by one as to why this is not the case. Okay, so that was the first reason. The second is like the notes are traded at discounts. So whatever the actual face value of the note was, when you were actually transacting with it, you were only getting like 70 or 80% or 90% of its value instead of like the entire 100% of its value because of whatever reasons. And number three is no central bank backstop means no contagion, which basically means like if in the case of a disaster, the central bank comes in, bails everyone out, and then at the end of the day, the banks are happy, and the economy is still intact. Which is not the case by saying something like reserve banks or central banks actually solve issues in the time of a economic crisis is a blatant lie, because just look at the 2008 financial crisis.
Right.
The banks collapsed, the US government came in, bailed them out, and who bore the brunt of the burden? It was the American taxpayer, and in extension, it was the global people. The banks took massive risks, and they didn't pay anything. They weren't punished. There were no repercussions. The banks stood some except from Lehman Brothers, who were unfortunately the only one who got crushed. Everyone else were bailed out simply, and the public was the one who with the taxpayers' money, the public one was the one who paid the cost. Yeah, so just saying that central bank can put a backstop into for contagions, that's just simply outright wrong. And number four is excessive profit incentive causes overissuance. Okay, so let's start by refuting the last one. Like excessive profit incentives causes overissuance. True, but the thing is, like if one bank is printing excessive amounts of money, the other competitors can simply look at the bank and say, okay, look, you are issuing too much money, so how about we have collected all of this this circulating money supply of yours.
Show me that you have the reserves.
Yeah, exactly. I will come to your branch and I will want to cash out in gold or silver, or which was all spacey at the time. And this was not only a theoretical concept; it was actually a very common
More
practice.
dwelling.
Yes, exactly. It was called note dwelling. Basically what it means is every bank had actually this thing called note pickers. These were agents who will go around collecting their rival banks' notes from the public, and when they had like a sufficient amount of notes, like a bag of
Mhm.
notes,
Right.
hypothetically speaking, they will go to the branch and say, okay, we have got this amount of notes from your public circulation, and we want it redeemed right now. And the bank had no option but to redeem it right then and there in solid hard currency. And yeah, so basically, excessive profit incentives causes overissuance is a theoretical concern that actually were negated very like sufficiently well in real world practices.
Right. And also, if you look at the pointers, the first two mentions US. I think it would be, which are completely different when we go to Scotland and Canada.
Oh yeah, exactly.
Yeah.
Exactly. So the US gets used as an example because in particularly in the US, the problem with the free banking or basically it's a misnomer. It was not it was not a free banking society. The economy was not,
Right.
but as you said, we will look into like how Scotland and Canadian free banking regimes worked and how it was actually infinitely much more stable and much more
And much more actually free.
Yes, exactly. It was much more free in its real sense, actually. Even like Scotland was freer than Canada, but both of them were very close to the ideal of free banking. The other 2 points are like notes traded at discounts and private money leads to instability. Actually, let's take a look at how none of these things were true in the concept of in the context of Scottish and Canadian free banking. So let's take a look at that first. What was so the story of Scottish free banking goes back to the early 1700s. That like 1716 was the first time when the Scottish free banking regime came into existence. When the Bank of Scotland's monopoly on issuing promissory notes ended, like once the monopoly of the specific bank ended, then everyone like there was no legal reasons why anyone else couldn't issue
Right.
their own private currencies. And what's more interesting about the Scottish free banking regime is that there were no like formal requirement that you would need to have this amount of reserve in your fuck in your what.
In your reserve.
Yeah. So what's actually most interesting about Scotland is that in their free banking framework, there was actually no explicit reserve requirement. You didn't require having this amount of gold or this amount of any other sort of asset in your reserve to start banking. By anyone, I mean anyone could start a joint stock company with start a partnership, and they have the bank. And once they have the bank, they have to basically bring in whatever amount of credit or whatever amount of asset that makes you look trustworthy in that market. And once you have it, you have a bank that's open to business, and you will start printing currencies. And that's exactly how the Bank of Scotland, the Royal Bank of Scotland, the British Linen Company, which actually later turned into a full-time bank, stopped dealing in linens. They all came into existence very rapidly, like in like 1727, 1746, and we had this concept of unlimited liability banks, which didn't require any sort of charters. Like as I said, like anyone could start a bank, and you would start as an unlimited liability bank, and
And
also
not only that, unlimited liability also increased the accountability of the bank owners. They're
yeah,
much more careful.
yeah. I mean, exactly. So that's actually the consequences. So let's actually look into the type of banks that were present at that moment.
Mhm.
So there were like as I'm telling that you didn't require a charter, but there were still charters in the market. Like for example, the Bank of Scotland, Royal Bank of Scotland, and British Linen Company. All three banks actually were chartered banks, so they had a license from, I think most likely from the British government. Could be an autonomous Scottish government as well. But whatever they had, since they had the charter, they had access to limited liability. By limited liability, it means like if the banks go belly up tomorrow, your personal properties will be protected, and you will only have to, like, the bank gets to cash out, and whatever the reserve is, that gets redistributed into between the note holders and the debtors that the bank has. That's but only three banks in this Scottish free banking era had limited liability, had the charters. All the other banks that existed, and the banks existed in dozens, what they would have had to do was like a pay off from their own pockets if the bank's reserve did not meet the sufficient liquidity criteria that it required to pay off the note holders or the creditors, or basically anyone that the bank owed. Anyone can print any amount of money that they want to, as long as they have the sufficient reserve. They gets to do whatever they want to do, and the sufficient reserves actually contained of different things. As I said previously, like, they did not have any rock solid requirement of you will need to require this amount of spacey or this amount of assets anywhere. They you could have your assets anywhere. So the primary and the first layer of asset was obviously the spacey, and actually in the later 18th century, the spacey reserves averaged between 10% to 20% of demand liabilities in the latter half of the 18th century, but it actually failed dramatically in the 19th century. In the period, let's say from 1800 to 1845, the typical spacey to liability ratio were in the range of 0.5% to 3.2%. So, like, if a 0.5% to 3.2% of £1 sterling, which was obviously the currency of the United Kingdom. So that only 0.5% to 3.2% was covered by gold or silver. The other percent of the reserve was divided and diversified into other kinds of reserve assets. The other reserve assets could be like regular note exchange and clearing systems, which minimize the need for spaces in interbank settlements. There was actually third type of secondary reserves, which was basically assets held in London. London was obviously the financial capital of the world at the time, right? And they hold properties there. They were owners of certain businesses there. So anytime there was a credit crunch, anytime there was a supply crunch back home in Scotland, they would simply sell their assets in London and send money back to the home offices to pay off anyone who wanted to redeem anything, right? And the fourth and final backstop was, as I was saying, unlimited liability of bank shareholders. If they have exhausted all the other options and they still cannot come up with the money that is required or that is owed, the owners of the bank, the stakeholders of the bank, has to pay
All the debts personally.
Yes, exactly. Pay those debts personally, to the point they will have to sell their houses if it's required. They will have to sell estates. So the accountability, as they say, like the skin in the game in these unlimited liability banks were immense. So, like, every time you thought of doing something fraudulent, or you would considered doing something that is slightly over the boundary, you will be faced with a very real consequence of your action, which is like you will lose everything, not just your business. So it actually really kept people in check. The system self-regulated itself. And although these banks were printing money as they wished, or as basically whatever their capital reserve allowed them to print money, they actually were legally required to pay out anyone at any point whenever someone demanded a redemption of their banknotes against specie. They would have had to do it like instantly. But in Scotland, they actually tried to create some different sorts of rules to ease the burden of the bank, especially on the redemption side of things. So they introduced this famous option clause system that would let the banks delay redemption in a crunch, and they will basically pay you interest for the delay, but they will say, like, we cannot redeem it today, but within the next 6 months we will pay you in specie whatever you owed, and we'll also, like, on top of that, we will pay you the interest to you. But this practice actually led to one of the most significant legislative intervention of the era. The banknotes. This actually led to one of the most significant legislative intervention of the era. The Banknotes Act of 1765, which was passed in the Parliament of London, did two critical things. It first of all, it outlawed the use of option clause, and it prohibited the issuance of any banknotes with a value of less than £1 sterling. The second thing, not so consequential for to our discussion, but the first thing is like it made the banking process much more much more transparent, and it made it much faster. Like banks could not get away with any sort of like uh, under the curtain shady dealings. Everything had to be presented face value, and whatever they were doing, they could only continue doing it if they could redeem the banknotes for specie at any moment's time. So one more interesting thing to show you just how cautious these free banks of Scotland were. Like if you are an average citizen of Scotland with a small business, and you wanted a loan from the bank, what you would typically have to do is go to the bank and sign up for a cash credit bond. A cash credit bond was like it's a sort of a loan that needed to be signed by the borrower, and you would have to bring two or more co-obligants or basically guarantors with you who had like good standing in society or in the community, and they would guarantee that this guy who is taking the loan is a trusted member of the society, and they will pay back the loan pay back the amount in due time with interest. So you are not taking any unnecessary risks here. Just it goes to show you how cautious they were in lending and lending their money to people. So yeah, this pretty much sums up what we looked at in Scotland. Scotland is actually, if you compare Scotland and in Canada, Scotland as a free banking regime where was created bottom up. That means the demand led to the creation of these free banks. Instead, no, there were no centralized legislation. There was no act of parliament or anything. It is just like the market saw that there is an opportunity here. People need these.
There was not enough like currency in the market, so someone saw the
Yeah,
gap and started creating
yeah,
the.
there was not enough currency. There was not enough credit. Small businesses needed capital to keep going, but there was simply not no uniform structure in the market that will keep the market cycle going and keep pumping liquidity into the market. And when these these private banks saw it, they took the opportunity, and it was what however long that it did work. Like for Scotland, it started back in 1717 and went long as 1845, and in this entire period it worked, I will say, almost flawlessly with very limited issues. Like obviously the air bank collapse was one of the biggest failures of this free banking era, and we will cover that. But before we go into the failures and the inflation and deflation regimes of these of free banking economy, let's just quickly look into like what Canada looked like. Canada was actually more of a top-down system. The Canadian free banking system was created by legislature. It was created by big banks, uh, and it started in 1817. It all started with the Bank of Montreal, which opened in 1817 as a private partnership, but it sought a provincial charter in 1821, and that's actually an important note here, that every bank in Canada had to be granted a provincial charter to become a bank. You couldn't just like start a business and you were a bank suddenly. No, it's like the parliament had imposed a certain amount of restrictions or certain criteria that you needed to fulfill to become a bank. So like for example, I actually have this written down here, one of the from one of the sources that I was doing my research. So the first Dominion-wide Bank Act of 1871 required subscribed capital of at least 500,000, and obviously it was 500,000 back in 1870.
Right.
I think how much money that is now, with 100,000 paid in before opening and another 100,000 within 2 years. And these requirements were tightened in subsequent acts. By 1890, a new bank had to have the full 500,000 subscribed and 250,000 paid in before it could be granted a certificate to commence business. So like the capital requirement were immense. So that means only a few very rich, very powerful people could actually start these banks. But that doesn't mean it's necessarily centralized. There were rich people, there were merchants, there were lords and business owners who had enough money to start these banks, and they were free enough from the government. They were free enough from any centralized economy. And actually, the fun fact here is that the first Canadian banks were actually created by Scots, like the Scots from Scotland, Canada, and established these banks. And in their charters, they explicitly fought for the permission to open up nationwide branches, so that obviously, like, not having any branches is actually what was like one of the major flaws of the American free banking system that we'll discuss shortly. But yeah, so as I already listed out the requirements of like what it required to actually get a charter from the Parliament, Canadian Parliament, and on top of that, you had like a specific asset backing requirements, like you needed to notes or liabilities were issued against general assets of the bank, not against like any specific deposit of government bonds. And by general asset, it means like your spacey stuff, like gold and silver, your real estate, your businesses, your anything that had any financial value could be considered as general assets. And the banks, actually, there was an issuance cap on Canadian banks. Like the total note circulation was strictly limited to the value of its paid in unimpaired capital. So that meant like the fractional reserve banking uh, scope were very limited here. Actually, in Scotland, since the reserve requirements were so low, Scottish banks could actually were actually running a pretty well maintained fractional reserve bank, whereas Canada didn't have this much freedom. On top of the issuance cap, there were actually multiple layers of creditors' protection. One of them was the Bank Act of 1880 that granted note holders a first lien on assets of a failed bank. With basically meaning like if the bank goes down, if you are a note holder of that bank, you go to the bank gives you first priority, and you convert your notes into specie, and you are made whole. So one of the primary difference between the Scottish system and the Canadian system is like the Scottish bank stakeholders had unlimited liability. So if the bank note holders were not made whole from the bank's assets itself, then the stakeholders had to sell their own houses, essentially, like their own personal assets to pay off the debt. Whereas Canadians only had double liability, so that means double the amount of the shareholders' secured assets, and we go from there. All right, so now let's look at the failures of I won't say free banking system, but the failures within the free banking
Of certain banks within the free banking system.
exactly, of certain banks within the free banking regime. And let's actually take a look at the graphics that I have prepared here. Okay, so one is the Air Bank of Scotland that failed in 1772, and the other is the Banque du Peuple of Canada that failed in 1895. And in both cases, were actually the failures were inflicted by the banks themselves. For the Air Bank, it was caused by reckless spending. Like they were expanding aggressively, and they were loaning out to speculative projects. They were giving out long-term loans backed by short-term assets, and it simply didn't work out. Like one disaster after another, and basically the public got wary of their reckless spendings, and at one point or another, one event caused panic, and everyone wanted to get their money out. It essentially caused a bank rush. It essentially caused a bank run, and
also it turns out that the bank ran for just 3 years, whereas when it actually failed, some owners had to spend up to 20 years to pay off the debts.
yeah, I mean that's the fun about having unlimited liability. Right? You owed your entire personal portfolio, your entire net worth was staked on that bank's future. Yeah, but the good thing is, not only were the note holders of the Air Bank were paid in full, but they were also paid with interest, because because as you mentioned, like these people were personally liable, and they had to repay them from their own pockets. So at the end of the day, like no bank today is going to pay you out in full. Uh, in today's economy, they are only going to like pay you to the insured amount that you have. In different countries, the insured amount is different, and in most, I think in almost all the countries, the insured amount is fixed and not a percentage of
Right.
index. So yeah, like it's fair to say that like the Scottish free banking regime was actually much more successful and much safer than whatever kind of banking system that we have today. Yeah, so that was Air Bank in 1772, and now we have a Banque de Peuple of Canada in 1895, more than like 120 years after Air Bank. And this failure was actually even much more blatant, much more of a
Right.
blatant fault of the bank itself, because one of the partners of the bank essentially lend out some fraudulent loans to some people, some like friends or family members, I don't know. And the size of the loans were so huge that it simply couldn't cover with the reserve that it had. Yeah, so as you can see, gross mismanagement and unsecured loan by the cashiers. When the bank collapsed, it obviously created a public outrage, but what it didn't do was create a banking crisis. The crisis was pretty much contained within the one bank that had the issue, and people were eventually paid out, like whoever, like note holders of the bank were eventually paid out, but unfortunately not 100%, but 75% of the asset that they were owed, primarily because of primarily because Canada didn't have unlimited liability. Canada had double liability, so they couldn't pay out the entire amount. But again, the banking infrastructure was still standing solid. It was just one bank within a huge gigantic ecosystem, and it didn't spread. Like just look at the 2008 crisis that we had.
Right.
One bank, like obviously it wasn't caused by one bank. The incentives that were created in that market, everyone were exploiting the mortgage backed securities flaws that the market had created and the bubble that it created. But essentially it infected everything, and everything went down, right? But not in this case. In this case, like again, the bubble was very localized and it was contained very quickly. And that is, whenever someone talks about like how uh, disastrously the free banking era ended, that's actually not true at all. And as I was saying, the primary disasters came from the United States. So, and in the United States, the free banking era was very short lived. It lasted for 20 years or so, from 1837 to 1865, and when Civil War started.
And also, it wasn't exactly free banking, like
Yes,
slightly nuanced.
yeah, not slightly, it's blatantly, uh,
Right.
because yeah, as I was saying, let me just basically. Yeah, so it started 1837, ended 1865, which was a civil war. At end of civil war, free banking infrastructure was entirely collapsed. Now, as you were saying, why the free it isn't exactly called free banking was because first of all, it wasn't like nationwide banking system. Like only at that moment, USA had 34 states. Of that 34 states, 18 states adopted the free banking infrastructure in some way or another, but it wasn't free because the states had imposed oodles and oodles of regulations on these banks. Like you cannot create more than one branches. You cannot.
Yeah.
You will have to hold this amount of state bonds in your reserve. You cannot do this. You cannot do that. And yeah, and while within this regulatory regime, some of the free banks actually did very well. Banks that had managed to establish a clearinghouse system by using the Suffolk Bank at Boston as their primary clearinghouse. It was actually primarily in the New England territory that were doing like relatively fine. And the fun fact here as well is like most of the people who started the banking infrastructure in New England were also like Scottish immigrants. Like they came to the United States and they brought their banking system with them, and they created this another a fairly stable banking system. But and everyone, whenever they say free banking, they inevitably will utter the word like Wildcat Banks. Wildcat Banks were actually not the norm. They were not actually not the primary forces in banking. Wildcat banks basically means these are like extremely shady banks that never really had any intention of actually doing any sort of banking or any real business. They just appeared overnight. They will issue some notes. They will do some business with some people, and then they will disappear. And if you held any of their banknotes, you lost money. This was it was a very intentionally operated fraudulent system. It's just an outright scam. It's not a banking system, and people confuse wildcat banks with the actual free banking system. Anyways, just going back to my actual point is the regulatory burdens that these banks in the United States faced actually caused most of the failures. Because, like, let's take one example. Like, most states in the South that eventually sided with the Confederacy in the Civil War, the prospect of civil war became imminent whenever that happens. And these state banks were properties of the United States, and the state banks were issuing bonds that were in effect a secondary issue of the United States government's state bond. So whatever value that these state bonds had the value because it was a state of the United States. And if the state itself decides to secede, if the state itself decides to break away from the United States, then what's the value of the state
They
bond?
become worthless.
Yeah, it becomes worthless. And what happens when the primary reserve of your bank becomes worthless? Bank fails, right? Yeah, so that's one. The another one, and it's actually a pretty stupid policy, which is like they were not allowed to branch out. That means one bank could only stay in one area, and that's it. So if that particular area where the bank's entire clientele lived, if that area were hit by, let's say, a famine, a drought, or a flood,
Or had a bad harvest.
yeah, exactly.
They have no options. The bank is
Yeah, the
doomed to
bank
fail.
is screwed, right? Because the people don't have money. They're not paying the loans back. There are no other businesses to do profitable business with, and the bank eventually goes under. Whereas in Canada or in Scotland, the banks were like allowed to branch out extensively. So even if like one area had some troubles, one area were running in losses due to some odd events, the other branches in other areas will be able to
finance it.
Yes, exactly, to finance it.
And in the US, it seems like centralization was the reason that free banking did not work. It wasn't exactly free banking why it failed.
It wasn't free banking at all. It was essentially a centralized, inefficient banking system masquerading as free banking, because the notes were issued by
Very well put.
private banks and not the federal government, right? Now let's take a look at the similarities between privately issued stablecoins and what was happening in the free banking regimes in Scotland and Canada. So yeah, let's take a look here. Like banknotes were liabilities of private banks, redeemable in specie, and in the post-Genesis stablecoins are liabilities of private issuers, redeemable in USD and equivalent reserves. That's pretty much the same system,
right?
And also like the backing with real assets, the same thing. Free banks were backed by gold, silvers, or short-term commercial papers, whereas like post-Genesis stablecoins are backed by treasuries, repos, USD, cash deposits, etc. And in terms of convertibility, you get to redeem your whatever you hold a 1-to-1. Back in the day, it was redeem in gold or redeem in silver, and now it's redeem in US dollars. And it's pretty much an extremely similar system to what we had earlier in the free banking era. Yeah, so as you can see, like the primary infrastructure of the privately issued stablecoins and free banking era Scotland and Canadian banks are very similar. These are all private entities. They are issuing some sort of a currency backed by some other harder currency, and they have the appropriate network. They have the distribution channels, and most importantly, they have the trust. And how is this trust created? It's created by the assurance that whenever I need to redeem my banknotes for physical assets, or basically hard or more trusted assets, I could just do it instantly. So what that means is, if you are holding physical cash notes in the free banking regime or in the free banking areas, you simply show up to the bank branch, you give them your cash notes, and they give you whatever the equivalent is in gold or in silver. And in this case, you simply go to you have stable coins, you simply go to a centralized or a decentralized exchange, you exchange it for something else, and it's totally doable. Yeah, so trust is the biggest thing, right? And what happens when there is a run on the bank, so to speak? You have to sell your assets, right? For stablecoins, most specifically, like if more people want to redeem their stablecoins than to buy it, they will simply have to sell their US treasuries, whatever repo they have, whatever cash they have, to make the stablecoin holders full. And that's all there is to it. Like the entire argument that free banking is like an inevitably harmful thing that collapses, destroys the economy, and stuff like that. This sort of argument are only made by people who are either are not entirely aware of what actually transpired in this period, or they actively don't want invention to sorry they actually actively don't want invention to take place and take control away from the federal government or the central government and give it to the free market. Because at the end of the day, free market knows what's best for you. Free market is extremely good and extremely effective at self-regulation, because uh, it's very much a player versus player arena, where if one company is exploiting some sort of a loophole, either another company will exploit it and the arbitrage delta becomes thinner to non-existent, or they will simply like challenge the company financially and try to short its stock, or try to do challenge it in some other financial capacity, uh, to make them stop. The actual concern that I do have is like monopolies. Monopolies are serious issues in the private market, when one company gets so big that it starts consuming other companies, and that is going to be like a real challenge at some point. And it has happened previously as well. Like most famously, in the early 20th century, the Rockefellers company grew so big and it spanned so many different industries that the United States government was compelled to break it, and create smaller companies out of it. So that the economy could sustain and small companies could start their businesses. Very similarly, like if Tether or USDC gets so big that other stablecoin issuers cannot like hold any ground, then they will have some undue leverage over the industry, and that's a bad thing. But thankfully, there are like what we're looking at from the Genius Act is like there are certain requirements. If those requirements are met, anyone will be able to uh, issue their stable coins in the US. And obviously, like the market share, whatever the market share battle between USDC and Tether is, more and more new player will come in and they will battle it out, and figure something out, right? So as long as there is no obvious monopolies, or if a duopolies, I am good with the entire system.